All right, today we're going to dig into Windlas Biotech. Now, on the surface, this is a pharmaceutical company that looks like it's absolutely crushing it. But when you start to peel back the layers of their financial reports, you find a much more complex and honestly, a way more interesting story.
So the first number you see is a big one, a massive 22% year-over-year revenue growth. I mean, in any market, that kind of top-line growth is going to make you sit up and pay attention. It's strong, no question about it.
But here's the puzzle. While revenue is shooting for the moon, the bottom line, the actual profit the company gets to keep, well, it's kind of lagging behind. And that sets up the big question for us today. If sales are this good, where's all the money going?
Okay, let's get into it. First up, we're going to break down those numbers. This is where you can really see that gap between the sales growth and the profit growth, and it sets the stage for the huge strategic moves happening behind the scenes.
Okay, check this out. It's a tale of two halves, right here on one slide. Revenue for the quarter, a solid 187 crores, up 22%. Then you've got EBITDA, that's basically your earnings before all the accounting stuff like interest and taxes, and that's looking good too, up 23%. But then you hit the bottom line, profit after tax, or PAT, and it's only up 12%. And that is the puzzle we're here to solve. Profit growth is literally half the speed of revenue growth. What gives?
And hey, it wasn't just us who picked up on this. On the company's big earnings call with investors, analysts were all over it. This quote from Rishi Kothari nails it. He's pointing out that profit margins, which are usually around 9.5%, suddenly dipped to about 8.5%. Now that might not sound like a huge drop, but in the world of finance, it's a big flashing light that something fundamental has shifted in how the company is spending its money.
So what is that big shift? Well, that brings us to the real heart of the story. This is where we pull back the curtain on a massive strategic investment that explains everything. This, right here, is the billion-rupee bet.
Okay, so here's the absolute key takeaway. It's not that the business is suddenly broken or less profitable. It's much simpler. The company is spending a ton of money on future growth, and they're feeling the financial pain of those expenses right now, before the projects they're funding have even started to make them a dime.
Now, to really get what's happening, you need to know what Windlas does. They're what's called a CDMO. Basically, think of them as a super high-tech, expert manufacturer for hire for other big pharma companies. They make the medicines that other companies sell. And this is totally central to their growth plan.
And this right here, this is the smoking gun. The main reason for all these new costs is a brand new, massive manufacturing plant for injectables. So all the costs to run it, staff, electricity, all that, are already on the books. The depreciation, which is the accounting costs of all that expensive new machinery, has also started. But the cash register won't even start ringing from this plant until next quarter.
And to pour a little more salt in that short-term wound, it's the way they account for these costs. They use a method that front-loads the pain, making the expense look biggest in the first year. And get this, management said that a whopping 95% of their entire increase in depreciation costs is coming from this one single plant that isn't making them any money yet.
So yeah, you could look at this and just see a big drain on profits. Or you can see it the way management wants you to see it. This isn't just a cost, it's an investment. It's like pouring the deep, expensive concrete foundation you absolutely have to build before you can even think about putting up a skyscraper. They're giving up a little profit today for a whole lot more capacity tomorrow.
Okay, so they're laying the foundation, but what's the blueprint for the skyscraper itself? How exactly does this all fit into their grand plan? Let's take a look at what they're trying to build.
And here it is, the big number, 1,000 crore rupees in revenue. That's the goal. That's the mountain they're planning to climb, and it's a huge leap from where they are right now.
So how in the world are they going to get there? Well, they've got a pretty clear three-step plan. Step 1, flip the switch on that new injectables plant and start bringing in cash, starting next quarter. Step 2, keep expanding their other factories. And Step 3, just keep pushing their existing businesses, reaching new markets, and getting their products in front of more people.
Now this chart really shows you the scale of what they're trying to pull off. See, if you just kind of multiply out their recent performance, they're on track for about 724 crores a year. That 1,000 crore target is nearly a 40% jump from here. It's a bold plan, and it's banking everything on these new investments paying off big time.
All right, for our last section here, let's zoom out a bit from all the spreadsheets and financial reports, because a strategy like this, taking a hit on profits today for a huge payoff tomorrow, that kind of decision doesn't just come from nowhere. It says a lot about a company's culture and its core beliefs.
You know, it's so easy to get caught up in crows and percentages and completely forget what the company actually does. They make medicine, things that people rely on to stay healthy. And that core mission, making these essential products, is really the bedrock of their whole business.
And this commitment to community, it doesn't just stop at the factory gate. You look at their reports, and they're doing a lot. They're helping out hospitals, funding schools for young people who have to work, and even helping create new tech to teach kids about the environment. It's pretty cool stuff. You know, I saw this quote from their own company values, and it just clicked. Discipline. Make and meet commitments. In a way, that's exactly what their financial strategy is, right? It's discipline. It's making a tough, costly commitment now so they can meet their huge growth commitments for the future.
And that really is what it all boils down to. You've got this amazing revenue growth, but it comes with a catch. Huge upfront costs for a massive expansion. They're very clearly trading today's profits for a shot at a much, much bigger tomorrow. So the final question is pretty simple. Looking at their plan, their discipline, and their ambition, is this billion-rupee gamble a bet that you would make?